Hello and welcome to our first podcast, where we explore the critical intersections of global trade, risk management, and the evolving world of credit. Today, we're joined by two leading experts in the respective fields. We'll be discussing the current landscape of global trade, key risk factors, and strategies for businesses to manage uncertainty, and also what is transforming credit management. I'm your moderator, Valerio, and I'm thrilled to introduce our experts. First, we have Gordon Cessford, president of Atradius Trade Credit Insurance. He has managed the North America region for 6 years, contributing to growth and becoming a point of reference within the credit insurance industry. Gordon, welcome.
Thank you very much, Valeria. Pleasure to be here. Just to go over what you said, I'm President CEO of Atradius in North America. I'm deemed to be a veteran of credit insurance, having run underwriting businesses for over 25 years and across 3 continents. I've also worked in credit management, banking, and corporate recovery. So I've got experience of the full credit cycle, and I'm well placed to understand both the pressures and the opportunities that face our customers and partners as they look to navigate the world of credit risk management.
And next we have Aaron Rutstein, Director of Risk Services for Atradius North America. Aaron has been at the helm of Risk Services for 8 years now and successfully navigated through a couple of economic crises and a pandemic, but managed to maintain Atradius in a great shape to support our customers even during those hard times. Aaron, it's a pleasure to have you.
Valerio, it's my pleasure to be here. As you said, I've worked in the industry now 20 plus years at various carriers, all in roles related to risk and credit management. Currently with Atradius, I'm managing our risk operations within the Americas, where we have regional offices on 2 continents in 4 different countries. And obviously there's never a dull moment within the world of credit management. So always something to look forward to, and happy to be discussing that today.
To kick things off, Gordon, could you set the stage for us? What are some of the most pressing issues in global trade right now?
It's more a question of where to start, to be fair, Valeria. Let's start close to home, so here in the US. And what we've seen within a very short space of time is the impact of Trump 2.0 on the US, the North American, and frankly, the global stage. We've seen an attempt to try and introduce tariffs for both Mexico and Canada as a tool really to crack the nut of illegal immigration and drug trafficking. On top of that, DOGE is undertaking some significant cuts to government spending. The outlook of that, or the expected consequences of that, are in the short term some inflation being the likely outcome. Those tariffs, which were announced 25% on Canada and Mexico, have subsequently been put on hold. But that brings its own uncertainties, and that's not good for trade or market stability. We've got the ongoing conflict in Ukraine, which has disrupted trade, particularly in the energy and agricultural markets. We've got the sanctions in Russia. Those have impacted grain exports from Ukraine, created volatility in global commodity prices. And then we've got things like the extreme weather events and climate-related disruptions, which have affected agricultural production and logistics networks globally, labor shortages and disputes in key sectors, including shipping. And then, if that wasn't enough, we have increased regulatory and compliance requirements. So all of these disruptions increase costs. They lead to longer lead times and a reevaluation of businesses of their supply chain strategies. If I can move forward, what we have to make sure is that policymakers need to carefully weigh these potential costs of an escalating trade war against any perceived benefits of imposing those tariffs. Then we've got the ongoing tensions between US and China. Again, it brings uncertainty. It undermines investor confidence, as effectively we've got the 2 largest global economies engaged in trade disputes, geopolitical conflicts, and competition for technological supremacy. So again, unpredictability in that relationship, and investors are becoming cautious, probably preferring kind of safe haven assets over equities, which can stifle the market growth and the innovation.
Thank you for the comments so far. Talking about the potential impacts of tariffs and trade wars, we also have reached out to another expert, Atradius Chief Economist, Dr. John Laurier. In his role, he can give us a high-level view of the effects of these last events on the global markets. Here is what he had to say.
Yeah, inflationary impact of tariffs is very clear, and I think the main point is that higher inflation at the current stance of the U.S. economy will imply that that the Fed will be very reluctant to accelerate or continue with its easing cycle, monetary easing cycle. And with the threat and with tariffs coming in, that this situation will worsen and will keep them from cutting interest rates. But on the other hand, this is not from a U.S. Let's say growth perspective, not a extremely bad situation, because the U.S. government is still very, very expansionary in terms of providing boosts to the economy with these very high deficits. So that element also kind of forces the Fed to keep interest rates relatively high, and it is not something that we see in the rest of the world. Certainly not in the UK and the Eurozone, where rates are certainly going down. In Europe, we can use a dose of monetary easing.
Thank you very much, John. It is clear there are a lot of factors at play. Thank you for that overview. Aaron, let's shift our focus to the challenges that businesses are facing, especially when dealing with B2B trade. What are some of the key issues you are seeing?
Yeah, I think following on from some of Gordon's comments, we also have to put the current environment in the context of what's going on with both monetary and fiscal policy. So the government spent inordinate sums of money in the COVID years trying to prop up economies, and we've still seen, the impact of that working its way through various sectors and industries. The fiscal policy side has been fairly robust now for several years. On the monetary policy side, we were expecting sort of the Powell pivot, so to speak, but in light of the nascent uncertainty with the new Trump administration and their policies, it's become the Powell pause, where rates are being held at a level until there's more certainty around what will happen. It can affect planned investments because the interest rate's a key component in return on investment, but also higher interest rates lead to higher debt burden and servicing costs. And so the less money you have at your disposal could impact payment pattern behaviors with regard to suppliers. Approximately half of all companies in our most recent survey reported some kind of a delayed payment within the last year. Most of that, in fairness, is administrative, but that also highlights some of the complexity related to managing receivables and payables. Again, most payment delays are generally resolved fairly quickly and they're administrative in nature, but we are seeing an uptick in insolvencies in the U.S. related to some of these issues, the high interest rate environment, et cetera. And so companies need to remain vigilant and be sort of closely monitoring the situation to make sure that slow payments don't become bad debts and impact cash flows to a greater extent.
If we look at it more holistically for both of you, what are the range of concerns that businesses have in the short term and in the long term, and which are currently the most concerning for businesses, in your opinion?
I've mentioned it a couple of times already. Economic uncertainty, so fluctuations in the markets, geopolitical tensions, inflationary pressures. There's never a certainty, and it just creates that unpredictable business environment. So companies really have their work cut out trying to navigate those uncertainties whilst maintaining their plans for growth and investment. Second issue that I would kind of focus on is, the resilience of that supply chain, whether it's a geopolitical issue in terms of getting the goods to where they need to be in the shortest possible time, or whether it's, onshoring, nearshoring. Companies have to make sure that they have a very, very resilient supply chain and a diversified one, not just relying totally on one supplier or one small group of suppliers. Aaron, I'm sure you've got other ideas.
I think we're generally on the same page, Gordon. I think one of the issues that you touched on is just decision makers want certainty. And I think what we're kind of talking about is that in the beginning of 2025, we have anything but. We don't know what interest rates are going to be. Therefore, what kind of long-term investment decisions are going to be made. We don't know exactly what tariff policy is going to be. So therefore, what relationship with suppliers or various other supply chains do you take? There's a lot of complexity in the current environment, and I think that speaks to now more than any other time, we need to see vigilance in terms of managing one's receivables, because with everything else that's going on, you certainly don't want to have cash flow disruptions that further limit your flexibility to be able to manage through what is a more volatile period.
Thank you. Aaron, you are the risk expert. So in your opinion, how are businesses responding to these payment risks? What strategies are they employing to maintain stability as much as possible?
Well, I think one thing we've seen through the period, going back in the early days of COVID, is a lot of companies refinanced at what were still historically low rates. And so on the corporate side, they're fairly well cushioned there. What we do expect, though, is more of a wave of refinancing activity as these bonds and notes tend to come due from 2025 through 2027, 2028. So we see corporate balance sheets in fairly good position across the board. But again, it's critical to pay close attention to the quality of the customers and suppliers you're doing business with. We definitely see more of a heightened awareness in terms of these risks. Lots of discussion about how to manage through some of these risks. For us, I think one thing that we're noticing is that our past due activity from our customers has picked up within the last 18 to 24 months, I would say. We're seeing in particular large bankruptcies at a level on par with, say, the global financial crisis. I guess in relative good news, these are largely companies that were very heavily indebted, did not have a lot of flexibility, and then when inflation started passing through in a significant way in the economies, it was just a combination of a lot of factors that pushed these companies into insolvency. So those were largely, I would say, telegraphed. But I think what we're seeing now is that those companies that are heavily indebted, now with maturities coming and lack of clarity about interest rates dropping maybe as fast as we had previously planned, there needs to be a lot more focus on exactly how companies are going to manage through this cycle that's coming, particularly in light of the volatility.
So thinking about solutions now, what strategies you guys think can businesses employ to mitigate this risk that we've been discussing? Gordon?
In terms of supply chain, companies need to diversify those supply chains. Relying on a single supplier, as I've said already, or a single market can expose you to significant risks and shocks. So overall, diversify the supply chains, explore new markets, new customers, and that'll ensure or enhance companies' competitiveness, sustainability, and their long-term success. For me, it's all about relationship building trust, knowing your customer, knowing your supplier base, having flexibility built into some of those arrangements, because we know that things don't always run exactly to plan. And having a better relationship can also build, in the longer term, better terms and better pricing. And of course, there are companies such as Atradius that are there to help and support expansion in terms of the buyer side of things, looking at new markets, underwriting the risk, and supporting our customers in growing their customer base.
Perfect. Talking about that, can you maybe explain a little bit more in detail how a company like Atradius can help protect cash flow, help business continue operations even in the event of a buyer insolvency?
Yeah, so what Atradius and other underwriters do is that we assess risk on a number of levels. First of all, we assess the macro environment. We look at how countries are performing, how the global economy is performing, and then we drill down into how the individual buyers are performing. But actually, I leave this question more to Aaron as it's more in his wheelhouse. But we're very much there to support our customers as they look to grow, secure lending, create good corporate governance around their business. But Aaron's better placed to describe how exactly the risk side of the business works.
Yeah, thanks, Gordon. I think there were some comments that you talked about that I'd like to elaborate on further. Certainly, supply chain diversification, customer diversification are good things. And any kind of risk management, diversity is usually good. You want to spread your eggs around and not have them all in one basket. There are positive and potential areas of concern when doing so. I mean, lots of companies have built up established relationships with vendors and customers over a period of years. And so they know these customers quite well. They understand their industries. They understand the local rules and regulations. As one starts to branch out into new industries or new geographies, the familiarity with the local rules, regulations, the customers, the players, and the relationships are not always the same. So while the diversification can help, it also does lead to new challenges that one needs to consider. And so from a credit management standpoint, know your customer is always sort of imperative. In terms of credit management, if you don't have credit management procedures in 2025, you should hurry up and get some. You should think about, hey, when my customers don't pay, what am I going to do? What would happen if I got a tariff slapped on, a country that I'm importing to? How might that affect me? Do I have potential customers from that product in my local market that I could reorient to in a fairly short period of time, et cetera? There's lots of complexity, and I think it's critical that one has a proactive thought process about how to manage through these risks. Now, obviously, companies can do that in myriad ways, internal credit departments, procedures, et cetera, but partnering with trusted partners outside of their own area of expertise, companies that might help enhance collection activity, companies that could help with various credit management software or tools, engaging in information providers that can yield additional reporting on various trade payments, activities, sector information, and of course, protecting what is largely one's largest uninsured asset, which is accounts receivable through a trade credit insurance policy, are all certainly techniques and tools available for one to help manage these risks.
Thank you very much, both of you. Now let's shift gears to a very current topic. Aaron, how is AI changing the landscape of credit management in your opinion?
What we've been working with in terms of AI within the credit insurance space is using AI to help streamline efficiencies in terms of various manual tasks to create more flexibility to do value add issues, but also to really aggregate data and analyze data in a way that's just fundamentally more efficient than what a human could do. A lot of times when a human being looks at certain information, there's biases about what you're looking for and what you think matters. What we've found is that these neural networks, fuzzy logic, et cetera, are ways to crunch large sums of data, which ultimately help speed decision-making, increase actually our risk acceptance while simultaneously deliver a better overall risk return, which enables us then to take additional risks for our clients and help secure more of their receivables under an insurance policy. You need a partner who has those kind of technologies available, because otherwise there's so much information coming at you from all angles that you really need these tools to help digest it, synthesize it, and figure out, what do you do with it? And that's, I think, where AI really helps automate some of this thinking.
No doubt AI has significantly boosted productivity, particularly for automating information retrieval, machine reading of financial statements, that kind of work. So quicker analysis and decision making, and then leaving the decision at the end, if you like, in the hands of the underwriter. But the processing, the extraction, and actually finding different data sources, artificial intelligence no doubt has added to that. It's not without its challenges, however. My recommendation would be start small with processes which are familiar and assess how AI can support and develop the performance. Embrace the tools to enhance those processes without making drastic changes, canceling systems before you really understand what's going on and what AI can support. And then choose the partners and the vendors carefully. Do the due diligence, which needs to be done on these providers. Our customers are already benefiting from the investments that Atradius is making in artificial intelligence.
3/4 of all of our underwriting decisions are currently taken, algorithmically, which is up significantly from where we were, say, a decade ago. And this speaks to what Gordon was talking about. And I think this only continues, right? We're going to see additional AI tools help in terms of policy manuscripting, claims handling, various KYC elements. So I think in the next, 3 to 5 years, the advancements that are coming are going to be profound.
So it seems like your suggestion, your recommendation is to use these tools to improve efficiencies rather than completely rewrite processes from scratch.
I would say so, yes. Who knows in the future as technology develops what will happen.
This has been an incredibly informative discussion. To recap, we've covered a wide range of topics today, from the impact of global political events and trade disruptions to the importance of managing payment risks and the exciting potentials of AI in credit management. A big thank you to both of our experts, Aaron and Gordon, for sharing their valuable insights. Thank you, our listeners, for tuning in. We hope you found this podcast useful in navigating the complexities of global trade. Until next time, goodbye.